All right. So now that you've seen how an LOI looks, I just wanted to clarify the difference between an asset sale and an equity sale or a stock sale because it's really important that you choose the right M&A structure, and sometimes you don't have full control over you can actually do or what you can actually end up with because the seller might just be too aggressive in what they end up sticking with. But I want to talk about specifically the differences between an asset sale and a stock sale and kind of recap what we've covered. So, in an asset sale, right, that's what the buyer prefers. Okay, you as a buyer, if you're looking to buy a business, you want to do an asset sale because what's happening is you kind of pick and choose what you have. And so, what I mean by that is that you're not worried about all the historical liabilities or the historical tax practices of the seller, right? Because you're not involved in that entity. You're basically buying the customers, the machinery, the assets, all of the things that make the money in the business, and you're leaving everything else behind. So that's kind of a key thing here where usually these are cash free, debt free deals, meaning the seller, yes, they keep the cash in the business, but you're not buying any of the debt. So you step in, you're buying all the assets, and so you're able to reduce risk by avoiding any unknown liabilities by the seller because you're not kind of taking over the tax return, you're not taking over the EIN, you're starting a new business, new bank accounts, and you're just basically acquiring the customers and the employees and things like that. So, aspect of the asset sale is that you get potential tax benefits through what's called like a step up in basis. And basically, what that means is that there's depreciation and amortization, which are amazing tax deduction systems that the IRS allows for, which means that basically you get a benefit that even if you buy a certain kind of asset or equipment, you don't necessarily you get to kind of depreciate it over time, similar to real estate tax depreciation, right? All of that tax benefit. So the key thing though is that if you're buying an older business, right, maybe they have furniture and equipment or vehicles, and the typical IRS tax code only allows those to be depreciated over 5 or 7 years. So what might happen though is that you buy all this equipment or you buy all these vehicles, and technically what you can do is that even though the prior seller might have already fully depreciated those, because you're buying them, if they're still working, you get to redepreciate those assets at fair market value. So basically, it ends up being nice because then you can kind of typically you're buying these businesses for profitable cash flow, and so you're going to have to pay taxes. But now, because you get that re-step up in basis and you're not kind of starting from with zero depreciation, you can take that non-cash expense and get that tax deduction for it. So buyers typically always prefer an asset sale. Now, what happens though is that the only reason you won't do an asset sale is that the thing is for the seller, they don't like an asset sale because they get taxed on ordinary income. Whereas in a stock sale, they get taxed on, so it's preferred by sellers for capital gains tax advantages because on a stock sale, you are buying the EIN, you're buying the business, you're buying the name, you're kind of basically just swapping out the prior owner. And so everything stays as is from a payroll standpoint. You're taking over the bank accounts and all that. But now all of a sudden, the problem is that you might not know what you're getting yourself into. So, like hidden debts, legal risk, God forbid the prior owner wasn't filing his taxes right, you might be on the hook for that, right? So like you might be able to kind of protect yourself from the purchase agreement and kind of putting up all these contracts, but God forbid somebody sues the business for historical stuff that was around the time of the seller, you will now have to turn around and then sue the seller as well because it'll all come back because you're taking over the entity, right? Whereas in an asset sale, you're starting a fresh new entity, you're creating a new business, and you're just kind of putting those assets and those specific liabilities that you need into your business. Whereas stock sale, it's better for the seller because they'll get the capital gain, so they'll get a lower tax rate. Whereas in an asset sale, they're getting taxed at ordinary income. So that's something just to keep in mind is that buyers want the asset sale, sellers want the stock sale. And so there's always kind of that push and pull, right, of who's going to kind of win and where you end up. So this is kind of an overall summarized table where you can see that, okay, an asset sale from an ownership standpoint, you're just buying a specific set of assets where in the purchase agreement, you're actually going to list out everything you're taking over, right? The customer list, the contract, the equipment, the fixed assets, everything, right? The website, the software, etc. And so you get to kind of pick and choose and you have more control. So there's lower liability to you as a buyer, and you get to do the step up in basis, so it's favorable. Now, the reason it might be more complex is just because if you think about it, depending on the type of business that you have, let's say there's a lot of contracts that the prior seller had. If they're a construction business or a healthcare business or a government, working with a government entity, now all of a sudden you have to basically you have to do new vendor registrations, you have to do new protocols to assign all the contracts and all the historical customers from the prior business that they were working with to you, right? So that's why the asset sale ends up being a bit more paperwork, because if you have a business with a lot of contracts, for example, with customers or with vendors, you now need to renegotiate and redo all of those different customer and vendor contracts into the new entity. So it is a little bit more paperwork, a little bit more costly, but it's a lot lower risk. Whereas the stock sale is favorable to the seller because they're not being taxed at ordinary income, which could be 37%. They're taxed at capital gains. So because it's equity, it's a stock, right? So assuming that they've owned the business for more than a year, then they get to take long-term capital gains benefit when they sell. And so you can tell if it's a multi-million-dollar deal, having to pay 15 or 20% in tax rate versus 30 to 37% in tax rate is a major difference. And so sellers are always going to push for this. But at times, right, if you're working with a government contractor, or like your customers are with the government or healthcare companies with insurance providers, right, rather than going through the entire process again and the vendor registration and customer registration process, sometimes it's simpler where you're just kind of changing the name on the back end of the of the ownership structure, but you're keeping the same business intact. So just something to keep in mind. I just wanted to recap that. Hopefully that makes sense, and I'll see you guys in the next video.